Thanks for staying with us. You're watching Investors Guide on ET now. Dhirendra is still with us in our Delhi studio, and we're going to review the BIRLA SUNLIFE Tax Relief Fund. Now, before we go across to Dhirendra and we talk about whether this is the best tax-saving fund for you to invest in, Avan is going to give us a quick introduction into the fund. Avan.
The BIRLA SUNLIFE Tax Relief Fund comes from the mighty BIRLA SUNLIFE basket. Launched in 1996, this fund has rewarded its investors with an annualized return of 30%. The fund is an open-ended equity-linked savings scheme with the objective of long-term capital growth. It has a target allocation of 80% in equity and 20% in debt and money market securities. It comes under medium to high risk profile. The fund invests primarily in large cap stocks, but to prop up its returns, it invests close to a third of its assets in mid and small cap stocks as well. In 2008, the fund invested in auto stocks and held on to them despite the sector being underrated by the market. That move paid off in 2009 when the sector was among the top performers. Similarly, when the IT sector was available at low valuations, the fund built up positions in it. The sector turned out to be a star performer in 2009. Currently, the top three sectors of the fund include financials, energy and engineering. Let's bring in some numbers to get you a better perspective on the fund's performance over the years. So if you invested 1,000 rupees in this fund, you would have 7,629 rupees today. Now, should you add this fund to your portfolio, don't get all bogged down by the facts and the figures, because our experts are here to make things easy for you.
Thanks, Avan. But this fund was actually launched in 1996, so it's one of the oldest tax saver funds that we have in the market. What is your review of where you look at it right now from its returns and its performance?
It has a glorious past, but of late, past 2-3 years, it has speedily been on its way to mediocrity, and it shows it, on a risk-adjusted basis over the past 5 years or the past 3 years. It does not compensate enough for the risk it assumes. And it's fine that a tax-saving fund should assume risk, but relative to the kind of risk it assumes and the kind of volatility doesn't matter here, because even if it's volatile, investors come and they stay in such a fund for 3 years. So even if it is very turbulent, it should compensate for it. It has not done so far, and it is proving to be a reasonably average fund. Its initial years were glorious, and it was the first fund to in 3 years time it was up 10 times, which was first ever, but that's all history.
All right, so that's all history, but moving to the present, and for this year, the last year in which we can pick a tax saver fund, would you recommend this one, or do you think there are better options out there? Which are the options you'd say an investor should go for right now?
Yes, there are better options. Certainly, BIRLA SUNLIFE Tax Relief is not the first choice, or not a great choice today.
Right. There are better options out there. Then finally, your rating on the BIRLA SUNLIFE Tax Relief Fund. What is your star rating, and should we invest in it?
I would give it a 3-star, because it's not a horrible fund, but there are superior options. And I would say if any existing investor should not be very perturbed that he has invested in something which is turned out to be very bad. It's none of those, but it's not the best choice. I would say I would give it a 3-star.
3 stars therefore the BIRLA SUNLIFE Tax Relief Fund. Remember, Dhirendra said it's not the best tax saver in the market right now. Remember, we did talk about the HDFC tax saver last week, and he said that's a far better fund. So if you are picking a tax saver this year, and you should do it right now, remember, this is not the best option. Dhirendra, we have a question for you coming in from Dr. Ravi Mathani, who wrote in saying he's been investing in the Reliance Vision Fund and the Reliance Growth Fund. His last SIP went in January 2010. And he tells us he doesn't need the money right now, but he's not happy with the returns he's been getting from these funds. And he plans to switch to another investment. He tells us he's 48 years old, not ready to take a lot of risk. He wants to know if he should leave his money in these funds, or should he switch to a different fund?
Surely, not just because the fund is not doing the fund is not doing well, or it is proving to be an average fund or a relatively disappointing fund in recent times. But apart from that reason, he should be in a balanced fund if he is not prepared for the turbulence. So he should go for the Reliance Regular Savings Balance or HDFC Prudent.
Alright, Dr. Mathani, remember you need to switch to a balanced fund. It will suit your risk appetite also a little better, and it will give you, possibly give you better returns. They're giving you two balanced funds that you can invest in. Let's move on now. There we have a question that's come in from Samir Shah, who wrote on our Facebook page for Investors Guide. He tells us his father invested in mutual funds as a lump sum in 2006. Now the amount has doubled since then. He wants to know if he should redeem that money and reinvest it in the debt market given the bearish market insight. So he obviously is bearish about the Indian market. He thinks it's not going to recover in the near future. But would you recommend that he pulls that money out?
If you really believe in the foresight that he has, that the outlook is bleak, the bearish market ahead, then he should. But I think, for normal people and me, it is very difficult to perfectly time it. And the fact that, if in 2006 it was difficult to visualize, just looking at his investment time frame, in 2006 his father invested. Till 2007 the markets kept going up till December, and in January it crumbled and it was down by 50%. He would have lost his capital for a brief period, and then it has recovered. I think markets change track and they turn around when you least expect it, and I think trying to time your allocation or moving your money to fixed income because you're expecting something, market always surprises you. So if you need the money, by all means take it out, consume it. If you have a goal and that goal has been achieved, do that. But if it is a long-term investment and you don't have any such plan, don't try to resist your temptation to play around with making such drastic moves.
Alright, Samir, we hope that helps. Remember, you can reach us on our Facebook page, just like Samir has, facebook.com/Investors Guide. We also have archives of the show on the page if there's anything you missed that you'd like to take a look at again. And if you have questions for Dhirendra or any of our other experts, remember there's an email ID at the bottom of your screen as well. You can send us your email with your phone number so that we can get in touch with you if you need more information. Dhirendra Kumar, thank you so much for joining us on the show and answering our questions. We look forward to having you on the show again next week. On the other side of this break, we're going to answer some more questions on tax, so don't go anywhere.